Hello everyone, I'm Victor Dergunov. Welcome to the Financial Prophet. I'm glad to see you here, and you've come to the right place, because here we're always focused on staying ahead of the curve so that we can continuously beat the market. So let's begin. This week we're going to discuss the dropping market, the potential impact of tariffs, a possible recession even, and much, much more. So last week we discussed the sell-off and why it could persist. Threats of tariffs, rising inflation, Doge-related firings, and other factors have led to worsening sentiment in some areas, as well as weakening economic conditions and indicators, suggesting that an economic slowdown, or worse even, a potential recession, may be on the horizon. Now, this dynamic has led to an increase in volatility on Wall Street, with the S&P 500 recently correcting by about 6%, and the Nasdaq 100 has been hit even harder, dropping by around 10% in this relatively short time frame. If we look at the Russell 2000 index, it's actually down by about 15% from its post-election high recently. So we're really seeing a lot of carnage in many momentum stocks, like for instance Palantir dropping by about 40% or so, Exxon dropping by about 40%, AppLovin recently also having like a 40% drops. Many of these momentum stocks, including AI plays and in the nuclear segment, we've seen some considerable declines primarily in these names. And we can also look at the Mag 7, or the mega cap tech stocks, as many call them. So if we look at the mega tech here, we see that Tesla has declined by about close to 50% or 45%, something like that. Nvidia has now recently dropped by about 30% from its high. Alphabet down close to 25%. Amazon close to 20%. Apple and Microsoft and Meta platforms are also all down by about 20% from their recent highs. Broadcom is down by close to 30%. So we've definitely seen many meaningful corrections, especially in these trillion-dollar tech titans and the momentum plays. Now, the recent market cap drops have been nothing short of spectacular, because we've seen something like $1 trillion market cap drop in Nvidia. We've seen Tesla losing close to $1 trillion in its market cap value. So, I mean, combined, we've just seen a multi-trillion-dollar loss in these mega cap tech names. So really a lot of carnage out there. And, I've noticed that many market participants are on edge. Some are, concerned. Some are panicking here. So I kind of wanted to release this article and just clear the air a little bit, and also release this video just to give people, a perspective where I am, where I think the markets are, and how we should be possibly reacting to all this. So the $1 million question is whether we are near another near-term bottom, or if there's more transitory downside ahead, or if this is the beginning. Now, this is the most, of course, bearish scenario. If this is the beginning of a more significant and longer-term decline, like a prolonged correction period, or even a potential bear market. So definitely very interesting how there are so many different voices right now on Wall Street and on Main Street, and just basically everywhere. And it almost feels like there's some kind of a divide in the country right now. And it's really unfortunate that things are where they are. But nonetheless, we have to deal with the market that we have, and that's ahead of us, not with the market that we wish we had. In all fairness, we just have to do the best with what we have. So, in my view, there is way too much pessimism, and market participants may be overly bearish at this stage. Also, it appears that we're exposed to substantial negative news flow, and market participants may be overlooking positive catalysts like continued growth, solid earnings outlooks, continued Fed easing, fiscal stimulus, tax cuts, deregulation, and other favorable market dynamics that could be ahead. Now, again, we are continuously hearing this drumbeat of negative pessimism. This data point came in lower than expected. Tariffs are bad. Tariffs are going to make inflation spike, et cetera, et cetera, et cetera. However, on the other hand, we are seeing very little news flow relative to the positive factors, like the increased investments in our country. For instance, Apple announcing the $500 billion investment in the U.S. manufacturing, or Taiwan Semiconductor recently announcing at least a $100 billion investment deal in the U.S., or whether it's SoftBank with another at least $100 billion investment deal. So, I mean, we're seeing really many, many deals, and for some reason, they're being swept under the rug here, and they're flying under the radar. They're not getting the publicity that they should be, so they're not impacting the market positively as they could and as they should be, because really these investments are big deals, because first of all, it's really positive for American manufacturing, it's really positive for American jobs, it's really positive for America in the intermediate and long term, even if there could be some near-term hiccups regarding the tariffs. Basically, here's my view on the tariffs. So I see many negative negative characterizations of tariffs, but I think that perhaps there's some misunderstandings. For one, not all of the the higher costs associated with tariffs will be picked up by the U.S. consumer. On the contrary, much of the costs could be absorbed by the exporter that's looking to import into the U.S. market, who could need to actually just absorb the costs or some or much of the costs themselves in order to get their products into the U.S. market, which is the primary goal of many companies outside of the US. And so that's from the consumer perspective. And also we should recognize that tariffs are really positive for the US domestic economy, because if the US is not getting something overseas, if the US market is not getting something from an overseas company, it's going to build it, it's going to make it at home in the US. So, and this again goes back to the recent announcement of Honda Motors building a plant in the US as opposed to building a plant in Mexico because of the tariffs. This again is why Taiwan Semiconductor is building a plant in the US to avoid tariffs. So tariffs really have many positive implications for American industry and the American economy and the global economy, especially if we're looking intermediate and long term. Now, of course, all these intermediate and long term gains could come at a short term cost of slightly higher costs for some industries and some other minor disruptions in my view. But my question to you is, would you rather have a little bit of pain in the near term to have prosperity and potentially a lot of growth intermediate and long term? Or would you rather have, just basically no short term discomfort, but have that come with significant limitations on our intermediate and long term perspectives, whether it comes down to unfair trade or perpetually increasing debt or other factors? So in my view, option A is better. I will take a little bit of short-term pain in order to realize the real intermediate and long-term gains, because again, this is important, and this is, I think, is a factor that's being overlooked a lot. Okay. So let's talk about just the amount of fear in the market, because it's pretty staggering. Basically, we've seen several negative economic indicators, and now all of a sudden, what seems like the world is just coming to an end. Stocks are crashing. Everyone around me and, on TV is screaming that a recession is almost inevitable, et cetera, et cetera. So the fear and greed index is now around 20, or even actually, I saw below 20 recently, around 18 or 19, which indicates extreme fear in the market. The VIX also surged to over 20. I saw it hit 25 recently, which is extremely elevated. So we're seeing signs of substantial fear and uncertainty reflected in the market's momentum, in its technicals, in its put and call option ratio, on the safe haven demand, and in other areas. We are really seeing lots and lots of fear right now. Now, is the fear justified? I believe that it's really not, in my view. I don't think so. So last year around this time, the market was experiencing extreme greed to the contrary, and it led to a correction followed by another substantial correction. Now, on the other hand, the market is experiencing extreme fear, and it could lead to a rally here instead, and if not here, relatively soon. Also, we should consider that the level of fear is around where it was during the August lows. So this is illustrating considerable fear and uncertainty priced into the market right now, which is typically the time that we want to buy stocks and not sell them. Now, let's take a look technically, because really it looks like that we are around a low point here. So the S&P 500 actually cratered below its 200-day moving average in recent trading sessions. So this is something that we see relatively rarely, and this kind of illustrates that we're having a considerable correction. But I don't think that this solidifies the thesis that this is the beginning of a prolonged decline or a bear market. No, instead, I believe that we're having a constructive correction. Basically, we're seeing money coming out of some really high-flying momentum stocks and the possibly overvalued or overbought tech names, mega cap tech names, nuclear stocks, and other companies that have been doing really, really well recently. We're having just some profit taking here, and basically some nervousness in the market is creating buying opportunities for us, in my view. So we're testing around the 5,800 to 5,700 range here now in the S&P 500, and the base case scenario is for the market to find its footing around here. First, technically, we're seeing a lot of positives. Basically, we saw a bullish kind of reversal yesterday on strong volume, and we're approaching the 30 RSI on the S&P 500, and we're just seeing a lot of technical indicators pointing to oversold technical conditions, and there may not be a justification for this big of a correction right now. So let's talk about the recession fears a little bit and how they actually may be exaggerated now. So first of all, I wanna highlight that we've seen remarkable resilience in the U.S. economy, and despite some transitory setbacks, the robust growth it could persist. Also, I want to highlight that we had what appears to have been a shallow recession in 2022. Now, this wasn't publicized a lot because there's some debate on how you even classify a recession, but we did have back to back. We had two negative GDP quarters in 2022. So, in my view, that was a recession technically. So, it's not like the economy and the stock market have been just sky high for years. The bull market just started in 2023. Now, while a recession, now this is just my opinion, of course, but while a recession may not be the base case scenario, there are risks, and the risks of a slowdown are increasing primarily because of poor sentiment, fear, and uncertainty regarding what will occur next. And what will occur next, I mean, with tariffs, with the economic data, with inflation, with the Fed, with Doge, with AI and other markets, with growth in general. So, I mean, there are a lot of ifs and there are a lot of concerns, of course. And in my view, the market will continue to, or should continue to climb the proverbial wall of worry here. So I just want to draw your attention to a Goldman Sachs note recently. Goldman Sachs CEO David Solomon says that Trump wants to, quote, level the playing field with tariffs. U.S. recession has small, but not a zero chance. So basically, this is reflecting my view as well. I view the tariffs as a strategic tactic to level the playing field for America because whether you like it or not, the U.S. has been taken advantage of with other countries basically getting over on the U.S. trade-wise with much more favorable trade terms pointed towards their side. But now we have a president that wants to renegotiate these trade deals and wants reciprocity and wants tariffs and the trading field to be fair. So Goldman Sachs CEO is saying this, and I agree. This makes a lot of sense, and I don't see anything terribly alarming or troubling with the tariffs aside from the reaction that we're seeing from market participants to the tariffs. Now, looking at the recent data, we did see some soft data recently, especially with the much lower than expected consumer sentiment data that came out. This dynamic illustrates that a portion of the consumer is on edge and may have poor expectations concerning the future of the economy. This is concerning, and in this case, we could see consumer spending continuing to contract as some consumers brace for potential challenging times due to possible higher inflation, increases in unemployment, if you want to blame Doge and other factors. Now, I do want to touch up on Doge a little bit here. I know this is a very highly debatable topic, but so there are many questions surrounding Doge. And there are also questions whether Doge is even what it's doing is legal. And I see protests out there and so many people yelling for Doge to stop. And so many people just basically lining up against Tesla and Elon Musk. And I find this very concerning. And it's not just because I own Tesla stock or I find it concerning for various reasons. So here's my viewpoint. The majority of the U.S. population voted for the current president. Now, by the majority of the population, I mean the majority of the population that voted, of course, because I've heard comments in my articles about people saying that the majority did not vote for President Trump because there were many people who didn't vote at all. While it is true, I don't find it as a valid argument. So the majority of the people who voted, they voted for the current president. Now, Donald Trump, the current president, campaigned on reforming the government, specifically getting rid of waste, corruption, and stupid spending. So the president has an official mandate from the people of the United States, and that's about as powerful of a mandate as anyone could have. So he has the right to hire or fire anyone he wants at Doge. Period. Therefore, what Doge is doing is perfectly legal, and maybe in several years it's going to be much clearer whether this is beneficial or not, but we are probably going to see many federal employees likely continuing to lose their jobs in the near term. Now, again, these are just my opinions, but I will express them. The government is vastly inefficient. Now, I jokingly put this in my article because my mother used to work at the postal service for about 25 years. She worked there. So I recognized that, the postal service could never be a profitable organization, just the way that it functioned and the way that it continuously lost money and the benefits that all the employees were getting that the private sector employees do not get. This kind of inefficient is basically the way that, in my view, is the way that much of the federal government is structured. It's a massive bureaucracy think of it as like a GE around 2017, when it was a huge bureaucracy, hugely bloated and inefficient, and not doing anything good for its investors, which is an analogy for the federal government recently. It's become increasingly bloated and inefficient. It's doing less and less favorable things for its citizens, in my view. It's doing more and more damage by increasing the stupid spending and doing everything it can to siphon money from the taxpayer and line someone's pockets with the U.S. taxpayers' money, which is ridiculous. It's fraudulent, but it is what it is, and it is the reality of our corrupt government system that we have enormous waste, abuse, and corruption in the federal government, and something has to be done about it. Now, again, without any real checks and balances, corruption has become entrenched in Washington. And we're talking about truly staggering figures. I mean, just recently, almost $2 billion was uncovered by Doge, quote, misplaced taxpayers' funds, which was uncovered at HUD, of all places. Now, it's estimated that the U.S. government loses up to $500 billion a year just to fraud alone, which is such a mind-blowing figure. And all I have to say to that is just very, very sad state of affairs the U.S. government has become. And now the people put in charge of volunteering to improve this catastrophe that we've been living with for so many years. So now the people who have volunteered improve the system, increase government efficiency, get rid of the wasteful spending and stupid spending, and possibly even balance the federal budget at some point. Now these people are being vilified, and there's protests against them, which is absolutely ridiculous. Doge's mission seems noble, and it could bring down government spending and improve the federal government's efficiency in the intermediate and longer term especially. However, and unfortunately in the near term, it could continue causing unrest, uncertainty, and may lead to higher than anticipated unemployment from here. So we should be paying close attention to the jobs reports, of course. And we have a jobs report coming out on Friday this week. So we witnessed 143,000 new jobs get created last month, and the market anticipates to show a gain of 156,000 jobs on Friday. Private non-farm payrolls are expected to be around 108,000, a similar dynamic to the previous month. Now, we want to see a number that is around the estimate. A number above 200,000 or more would be negative in regards to the Fed rate cut probability. So we don't want to see a number that's too high. And we would like to see a number that is around or even slightly below the estimates. But still, we don't want a number that is too low, because a much lower than expected number could alarm markets. So we see something like below 100,000 jobs, it could alarm markets, implying that the slowdown is accelerating and the labor market may show more deterioration, possibly leading to a recession down the line. So we want to be really careful here to hit that Goldilocks zone in the jobs report. Now, let's talk about the Fed a little bit, because the Fed could cut rates sooner than we expected. The FOMC probably won't cut this month or in May. However, there is a significant increase, almost an 80% probability that the Fed will cut rates in June. Moreover, the rate cut expectations have increased for the full year. There's now about a 50% probability we will see 3 or more 25 basis point cuts this year, which is much better than the recent probabilities. Just 1 month ago, there was essentially a toss-up whether there would be 1 or 2 25 basis point cuts. Now we're seeing probabilities of 2 or 3, and pretty soon we could see probabilities of 3 or 4. Therefore, if the data continues worsening, it should increase the rate cut probabilities. So this essentially puts the Fed put back on the table for us. Now, let's talk about valuations, because obviously with the sell-off, they have gotten considerably cheaper recently. Now, there's still much debate whether the market is really expensive or not. Some market participants argue that this may be one of the most expensive markets in history, which is why it may be destined to crash. However, I don't see widespread high valuations. There are, of course, pockets of froth, but we've seen many corrections in the high-flying, individual stocks like Palantir dropping by 40%. Tesla recently dropped by about 45%. Axon, we saw a 35% drop. AppLovin down by 43%. Nvidia down by 30%, et cetera, et cetera, et cetera. We can keep going from here. Now, looking at major averages, a forward PE ratio around 21 is not that expensive, for the S&P 500, given the market dynamics. Moreover, we should look at the NASDAQ 100, which trades at only around a 26 times forward earnings ratio, which is cheap given its explosive dynamic and the emphasis on big tech in the space. Also, I want to draw your attention to the Russell 2000 small caps index, which trades at only about 23 times forward earnings estimates, which is pretty cheap given the constructive setup for the domestic economy as we advance. So here's my bottom line here. While the transitory volatility may persist in the near term, I remain bullish in the intermediate and long term. Now, the recent patch of the rough data, it could be transitory. Also, it's not clear how the tariffs or Doge will impact the economy. We shouldn't be getting so negative, and being so pessimistic. I think that when markets, especially now, we should remain optimistic until we really see concrete signs that we should be scaling back on our investments. And I'm just not seeing that right now. Um, So just because there are some tariffs going up and we're seeing a bit of a slowdown, it doesn't mean that a recession is inevitable. But stocks right now are trading like there's so much fear in the market that basically they're pricing in the start of a recession. Also, job losses, potential inflation, and other growth fears can be offset by Fed easing, continued AI growth, tax cuts, deregulation, fiscal stimulus, and other constructive economic events. So due to this bullish, intermediate, and longer term setup, I'm going to keep my year-end S&P target at 7,000. Despite some early volatility here, I was expecting this, so it's not like this post-election pullback correction, whatever you want to call it, is unexpected. It is something that we anticipated. Thank you for watching my profit report. And please comment if you agree or if you disagree with me. Those comments are even better. So if you enjoyed my video, please click the like, share, and subscribe buttons. You can also follow me, Victor Dergunov, at seekingalpha.com. And please feel free to join our highly successful investment group, The Financial Profit, also at seekingalpha.com. Thank you very much for watching. I really hope that you benefited from watching this video, and have an amazing day.